Welcome to my webcast on where we will assess the financial structure by applying ratio analysis. Based on the balance sheet and the profit and loss account, we'll discuss how to calculate liquidity ratios, solvency ratios and profitability ratios. Secondly, we'll look at the results and how to interpret them. So, what do the ratios say about the performance of the company? We start with liquidity ratios. This is based on the information found in the balance sheet and is therefore static as we look back in time. Liquidity itself says if we can pay the bill, so it's primarily about available cash, short term. First indicator we have a look at is the net working capital. This one is calculated by deducting the current liabilities from the current assets. The outcome is an amount and does not say that much. To say something about the amount, you need more information. To avoid this, you can also express this in a ratio, the current ratio, which is calculated by dividing the current assets with the current liabilities. As not all current assets are monetary, the inventory, for example, first needs to be sold before it becomes free cash, which takes time. So, if you want to know the position of the organization right now, you apply the asset test, or quick ratio. This is the quick current ratio adjusted for inventories. So now you know how to calculate these ratios, but what does it mean? First of all, you always look at the development in time of the company. So you compare the different years and you see any fluctuations. Alternatively, you could look at the sector and see performance. So you apply the benchmark. In case you do not have this information, you can always use a general rule of thumb. A current ratio around 1.5 should be considered okay. A quick ratio about 0.8 should be okay. The lower, the less funds. The higher, the better. However, if you have too much excess cash, it doesn't generate profits. So, you want to be around the numbers given. Now, let's have a look at solvency ratios. Solvency ratios gives the stakeholder information about the ability of the enterprise to meet its debt and other obligations. The debt ratio indicates whether a company's assets is sufficient to meet its liabilities. The higher a company's debt ratio, the greater the probability that it will default on its debt obligation. The debt ratio is calculated by dividing the liabilities with the total assets. Another important ratio is the interest coverage ratio. Here we relate the annual payment obligation with the annual operating profit. So, do we earn more with the capital than that the capital will cost us? The interest coverage ratio should be higher than 1. Based on the interest coverage ratio, one can determine an appropriate debt ratio. The lower the ECR, the lower the debt ratio should be. A general rule of thumb is a debt ratio of around 0.6. However, when the ICR is really high, a company could have a higher ICR without increasing its business risk. The last ratio to discuss in this webcast are the profitability ratios. Profitability is a reflection on how performance of the company has been over the last period. So it's about the profit in relation to the assets. Therefore, besides the balance sheet, you need the profit and loss account. There are many profitability ratios, but we just focus on 4 today. The gross profit margin, return on equity, return on assets and the average cost of debt. As total assets are divided in equity and liabilities, there are different ratios, so all providers need to get the information they need. Profit is an important condition for continuity, therefore we will start with the gross profit margin, the profit related to the sales. To calculate the gross profit margin, we divide the operating income, also known as EBIT, earnings before interest and tax, through sales. The gross profit margin should be compared with the industry, You can imagine that the gross profit margin on a carton of milk is lower than a sports car. However, it's easier to sell thousands of cartons of milk, and you only sell a few cars a year. Next, let's have a look at the total performance, the return on assets. So we're going to compare the EBIT in relation to all capital. EBIT because we're not going to look at the costs of the capital used, and we look at the average total capital to have a more realistic outcome. Remember, the EBIT reflects a period, so we're also going to look at the average capital available in the period. Easiest way to calculate this is by using the average of the total assets on January 1st and the 31st of December at the end of the year. As liability providers get a fixed return, interest, let's have a closer look at the returns of the equity providers. Return on equity. So we're going to look at the net profit in relation to the equity. Last, we have a look at the average cost of debt. The average cost of debt is calculated by dividing the total interest obligation by the average total liabilities. The average cost of debt should be lower than the return on assets, so the risk takers, equity providers, get a higher reward for their risk. This difference is called leverage. The leverage ratio can be calculated by the leverage factor, obtained by dividing debt through equity. One last thing to keep in mind is that the return on equity is after tax and return on assets before tax. So now we come to the end of the webcast. You now should be able to calculate liquidity ratios, solvency ratios and profitability ratios. But two last things before you continue. The company can always take actions to improve the appearance of the company's financial statements. This we call window dressing and is particularly common when a business has a large number of shareholders, so that management can give the appearance of a well-run company to investors who probably do not have much day-to-day contact with the business. It also may be used when a company wants to impress a lender or in order to qualify for a loan. The second thing to keep in mind is that the ratios are always calculated historical, because we look at data from the past, and we have not looked forward. So beside the static ratios you check today, also look into the future and assess the dynamic position. I hope you enjoyed this webcast. If you liked it, check out my other webcast. Should you have any questions, tips or requests, just send an email. Thank you for joining and see you next time.